Welcome to the Lend Academy podcast, episode number 211. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. Today's show is sponsored by Lend It Fintech Europe 2019, Europe's largest fintech event for lending and digital banking. It's taking place on the 26th and 27th of September in London at the Business Design Centre. Lending and banking are converging. Lend It Fintech Europe delves deeply into this new world, bringing you the latest developments in the most important areas of fintech. Lend It Fintech, lending and banking connected. You can find out more and register at lendit.com/Europe. Today on the show, I am delighted to welcome John Goodall. He is the CEO and co-founder of Landbay. Now, Landbay are a UK-based buy-to-let mortgage company, and we explain exactly what that means in the show. They've been around for a few years, and they're really starting to get some serious scale. Wanted to get John on the show just because they operate in a unique part of the market, particularly when it comes to fintech players. And, they have seen tremendous growth, and they've had a really significant commitment, one of the largest commitments of capital of any of the UK fintech platforms. And wanted to talk about that. And we talk about the state of the UK property market, how they're bringing technology to bear on underwriting, and how they're competing against banks. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, John.
Thanks a lot, Peter.
So I'd like to get these things started by giving the listeners a little bit of background about yourself. Maybe you can give us some highlights in your career to date and what you did before Landbay.
Yes, certainly. I did quite a few different things before I co-founded Landbay. Initially, I actually set up an executive search business that was focused on financial services, and I ended up selling that in January 2007. As it happened, obviously quite a good timing as we were focused on pretty much investment banking, and at that time obviously it was 8 or 9 months before things started going wrong. Mm-hmm. I then actually went and taught economics for 3 years. I read economics university and had been a sort of deep interest of mine. And this is obviously, as it happened during the crisis 2007, 2010, but obviously if you remember, it was also at that time that Zopa had started going in the UK. And so I'd started investing on Zopa and then latterly Funding Circle. And then after I taught for 4 years, I then went and studied an MBA, and I'd started thinking about peer-to-peer. And then I met my co-founder. Well, I worked briefly again in the city. I met my co-founder, Gray Stern, in 2013, and we set up Landbay.
So then what was it that you saw back then, and what was the idea that led to the founding of Landbay?
So I'd always been really interested in the peer-to-peer market. I said I was very early on in Zopa in terms of as an investor in the loans, and thought it was a really good business idea and a good innovation. And obviously during 2007, 2010, I was teaching economics, and a lot of my focus at the time obviously was on the mortgage market because the whole mortgage market around the world was blowing up, and that was what was driving it. And then when I did my MBA, I was thinking about business models and particularly in peer-to-peer, about setting a business up, and was thinking about mortgages and peer-to-peer. As I said, I then met Gray. Gray's background was not in buy-to-let mortgages as such, but he'd worked in property finance, and we started looking at various areas of property lending initially, and then we settled on buy-to-let. So it was always a case of actually, as it happened, buy-to-let in the UK had performed very well through the crisis, and so that was always part of the drive to create something that was relatively low risk, relatively stable, but also a large market. Most of the people in property lending had gone into development and bridging, which we always felt would be a lot more cyclical, obviously, and while obviously it performs well in good times, typically they don't do so well in downturns.
Mm-hmm, mm-hmm. Okay, so before we go any further, I want to just get something straight here for our US listeners specifically. What is buy-to-let? What does that actually mean?
So buy-to-let, in very simple terms, it is a residential mortgage in the sense that it's on a residential property, but it is for the sole purposes of letting out, if that makes sense. So it is not a regulated activity. They're not home loans, but the sort of properties that you're lending on are very similar to owner-occupied, as we call them here in the UK. But effectively, it is a business/commercial loan, but on a residential property, if that makes sense.
Right. And obviously, letting means renting. We don't use the word let in this country. Okay, so then you founded the company and you got going. But what was tell us about the loans themselves. Like, these are residential mortgages on, I presume, single family homes or apartments or whatever. But what's the loan sizes you're talking about? What's the duration and the interest rate, that sort of thing?
Yeah, so they're typically on houses or flats, so single family units in US terms, or apartments. Occasionally there's what's called multi-unit freehold blocks, where there might be one building with 4 flats in and that sort of thing. So there are a few other nuances, and also some small student housing type properties. But typical loan size is typically average is around about £250,000 sterling, 250 to 300,000. But that will range anything from maybe £75,000, and our max loan size is 2 million. But the vast majority sits between sort of 100 and 400,000. The duration of the loans can be up to 30 years, but, and this is this important thing, and again, this is very different to the US market and other European markets. The nature of the UK market is you have typically a fixed rate period, which is either 2 or 5 years in most cases, and then they revert onto a floating rate. And normally in the UK market, these mortgages are arranged so that at time of when they revert to the floating rate, people typically refix them onto a new 2-year or 5-year fixed rate product. So although the duration is technically long, the expected duration would typically be 2 or 5 years.
Okay, that makes sense.
And we're lending out at our weighted average sort of borrow rate is around about 3.5% on buy-to-let, and that is typically buy-to-let is typically 100 basis points higher than owner-occupied, if that makes sense. Typically, one other thing that's important is they are typically interest-only loans.
Interesting.
So people are paying monthly interest payments, but not the capital, no capital repayments.
Right. Okay. So then when they refinance, they really haven't paid any of the principal off. They're refinancing the full principal.
Exactly. And the way to think about, we always think about these as business loans, if that makes sense. So we are lending to businesses who the business happens to be renting out property, and the nature of that business model is they want to maintain leverage on their assets the whole time, if that makes sense.
Right. So then what are we talking about as far as loan to value? What's the average?
The average is around about 70%. We do occasionally go up to 80%, but again, the bulk is between 60 and 75%. You'll typically we underwrite typically based on obviously partly loan to value, but a large part is around affordability in terms of what the rental payment is relative to interest payment. For those listeners outside the UK, they may not be surprised to hear that obviously property values in London are typically much higher than the rest of the country, and therefore yields are much lower in London for the landlord, for the investor. And so you'll typically find the lower loan to values are actually the more expensive but lower yielding properties in London and then to a lesser extent the southeast.
So does that mean that most of your business is outside of London?
No, total mix actually. We're probably by pound amounts we're probably about 50% or so. Obviously, London is such a large part of the market, and as I say, they're typically larger loans. So what you do find is, our average loan size in London is probably £500,000, whereas obviously in parts of the north, they're typically 80,000, 90,000. So you don't do as many loans in London, but actually by pound amount, it still is by far and away the biggest region in terms of money out the door. Right.
And so then who are these borrowers? Are these sort of professional landowners, like professional investors, shall we say? Or is someone that's doing this on the side? I mean, who is the typical borrower?
So in the broader market in the UK, I mean, it can range from people who've got one buy-to-let that maybe, that they call them accidental buy-to-lets, where perhaps they inherited a property, or people got two people got married and they both have properties and they kept one and let one out, or people move out of London and they keep their London flat and rent it out, or something like that, they end up having a spare house, which sounds very nice position to be in. But then obviously at the other end, there's professionals who have got 20, 30, 40, 50, 100 houses. We're typically lending more to the latter group, people who typically have more than 4 properties, and maybe 10, maybe 20. It's not exclusively at that point, but we consider that what we call the professional, semi-professional market, and so they are running it like businesses. They may have another job. I mean, sometimes you find that, for example, this is something that contractors do, or consultants that might work 4 days a week, and then they spend a day then looking after their property portfolio, and they outsource some things. So they might not be out and out professionals in the sense that they have no other income, but it's obviously a material part of their income. So that's the market we typically focus on in terms of most of our lending, for people that are really, the way we look at it, are people who are treating it like a business.
Right. Okay. And so then I'm interested in about the technology side of this business, because property, I know in the UK as well as in the US, it's a very old-fashioned paper-based business with lots of manual paper going back and forth, or PDFs being emailed. But how have you kind of brought technology to bear on sort of the loan application process?
Yeah, so the application process is totally online. So it is paperless in that sense for us. So it's all uploaded online. All signatures are digital. I mean, still in the legal system, on the actual final mortgage document, the borrower has to do a wet signature. That's done between them and their lawyer, and there's our posters. So we still do get physical loan docs that are in post-completion, but the rest of the application is fully online. There's still a physical valuation, but all that's, we do insist that a valuer goes to the property, but that's all instructed online, et cetera. It is quite and it's automatically instructed. That's quite a slick process.
And then what's the time period from the time someone comes onto your site to when the loan is provided? What's the typical duration of that?
Well, it can vary, and often the thing that's important to say here is, obviously, if people are purchasing a property, they may not be in a rush to buy, and I think that's one of the myths that sometimes peddle, that people always want quicker. Sometimes, for various reasons, the person they're buying it off may not be wanting to actually transact for a few months, and obviously, if they're remortgaging, they may not be in a rush because they know their current fixed term might finish in 6 months' time, so they just want to lock in an offer and then not actually transact for a while. So we can operate. So generally speaking, we are not the slowest part of. We're the fast part of the process. We've completed mortgages in 21 days, and that's faster than the most bridging lenders can do. And people go to bridging, which is very expensive, that are in a rush. But so we do move very quickly if the borrower needs to, in terms of weeks. That is very different to all our competition. But in most cases, the vast majority of our cases take 2 to 5 months. But that's not because of the speed of our process. It is very much because the borrower, whether they're being purchasing or remortgaging, is not in a rush to transact.
Right. Okay.
They're in a rush to lock down an offer, and then actually they just wait to transact.
Right.
So they want certainty of funding, but they don't necessarily need funding, if that makes sense.
Right. Okay. Yeah, that makes sense. So then, I'm curious about the investor side of your platform, because you've talked about, these interest rates are pretty low, and obviously this is backed by property, but who are the typical investors? I mean, you set up as a peer-to-peer. What's the mix of like these individual investors versus institutional? Yeah,
so when we set out, you're right. I mean, we were out and out, retail peer-to-peer. And it's also worth saying, like a lot of markets around the world, we set up, we completed our first loan actually pretty much 5 years ago, a week ago. So it was July 2014 when we completed our first loan. Mm-hmm. And at that point, we were lending at, typically 5.5% or something in the fives. And obviously, base rates in the UK haven't changed. And therefore, we were giving retail investors typically 4.5% or so. Over that time, obviously, there has been compression in interest rates in the UK, even though the base rate stayed the same. For various monetary reasons, mortgage rates have just continued to fall, as have savings rates on the other side. And I'd say now we're typically lending sort of 3.5 or so, maybe slightly higher, and therefore the retail return is much lower. It's around about 3%. And as you rightly say, for retail investors, that's less interesting potentially than a lot of the other sites that give 5-6%. But although rates in peer-to-peer in the UK have fallen over the last 3 years, probably on all sites.
Yep.
And now what we do, about 90% of what we do is in 90, maybe even 95% of what we do is institutional, and we've had institutional funding now, as in and sustained institutional funding for over 2 years now, and that's really driven the growth over the last 2 years. Because, like you say, institutions like mortgages, whether it be banks, funds, that they can securitize them, they can leverage them, and because of the yield on them, institutions are typically want to do them at scale. So when we do sign institutional agreements, they generally are quite large, which is a nice problem to have, but the problem is then you can't do that many of them.
Right, yeah, of course. And so then what about, obviously this these are interest-only loans backed by property. I'm sure there's been instances where, whatever reason, there's been some a default or been a late payments. How is that just a tiny fraction of your book, or how does it work? Can you give us some insight onto non-loan performance?
Yeah, so we've had 0 non-performing loans to date. We've had some late payments that have been a month or 2 here or there. There's been one that there's only been one that went into 2 late payments, and that's now been totally cured, and now it's fully performing, if that makes sense. Mm-hmm. So there's been no defaults, there's been no arrears, and that hasn't happened in our case. And the reason this is very different from other forms of property lending is these are all backed by rental income, and typically the rental income will be 170% on average of the interest payment, and we have the legal rights to take control of the rental payments, so that if a borrower doesn't pay, we can then become what's called a receiver of rent, get the rent paid directly. We haven't actually had to we've had to threaten it once, but we haven't actually done it yet. And that very quickly means that loans do perform, because we can manage the property ourselves or with third parties who can help us do that. So buy-to-let is typically very, very well performing. The other thing that's important to say, again, particularly for your US listeners and maybe some other European listeners, mortgage lending, including buy-to-let lending in the UK, is full recourse lending. So people can't just walk away. If the property value is lower than the loan amount, they're still on the hook for it.
Interesting. Yes, that's not the case here. The financial crisis would have been very different in the US if that was the case. Okay, so I want to go back and look at the competitive landscape, because you're offering very competitive rates. I imagine banks are not going to be that much lower. But so tell us, in the buy-to-let market, who do you compete against? Is it the banks? Are there other sort of non-bank lenders out there? What's the landscape?
Yeah, so the buy-to-let is really typically 2 markets, and one is a market where we sort of slightly alluded to earlier, where it's amateur landlords who don't do it as a business. It's not their main form of income, and therefore banks view it as almost a residential mortgage, and they underwrite it and price it like a residential mortgage as well. And in that space, and historically that's the largest part of the buy-to-let market, and for people that know, the buy-to-let market in the UK is around about 250 billion in terms of outstanding. So it's about 20% of the UK mortgage market. It's about 37 billion a year in terms of gross lending, which again is about just under 20%. And the bulk of that market still is those much smaller landlords historically, and that is served by the big banks, Lloyds, NatWest, Barclays, the very large high street banks who are the dominant players in that. And then the other part of the market, which is probably around 15-20% of the buy-to-let market, is this more specialist part. And on that part, we are generally still competing against banks, but these are not the high street banks. They are mid-sized challenger banks who wouldn't be household names, but these are people like One Savings Bank, Paragon. These are typically FTSE 250 listed banks, and then some other non-bank lenders. The interesting thing with this dynamic is that former market, which is the last part, is shrinking in total volume, whereas the specialist part is growing around about 20% a year or so. And the former part, in terms of pricing, again, is priced like owner-occupied mortgages, so people are typically lending out in the twos, whereas the specialist market, they're typically lending out in the threes, if that makes sense.
Okay, yep, makes sense.
And most of our competitors, to your point, are banks, but it's really not the high street banks.
Okay. And so then the investors, the institutional investors you're working with, are they typically, the large financial institutions? If you're getting I want to talk about the $1 billion funding commitment you got as well, but like what segment of the market is coming to Landbay to put money to work?
It's a mixture of banks and then funds, which I suspect is different to most other marketplace lenders or peer-to-peer lenders in the UK. In most cases, what we've seen is funds who are coming, who then buy loans and securitize. In our case, we've worked with some of those, and we have others that we're speaking to, and those are interested in assets because they typically, credit funds have bought books of mortgages and securitized them. It's one of the things that they've done. But actually, at the same time, banks like mortgages. They're very efficient from a capital point of view, and in the UK, most banks' balance sheets is predominantly mortgages, is how they can get volume away. So typically, I think the thing that's slightly different with us, with other peer-to-peer marketplace lenders, is actually there's a lot of banks that we speak to. Some banks do lend on our platform as well, which is slightly different probably to the rest of the market.
Right. And so then let's just talk about that. It was just a couple of weeks ago as we were recording this, the £1 billion funding commitment you received from a nameless financial institution, or an unnamed, shall we say, financial institution. So tell us a little bit about the genesis of that deal, because obviously that's a pretty significant deal for a company of your size.
Yeah, it is, and actually, it came out relatively quickly. It was a relatively quick process. I mean, obviously, we were already starting to lend at decent volume. We'd already had institutional funding on the platform. In the UK, we've won numerous awards for best buy-to-let lender, and not just best buy-to-let specialist lender, but best buy-to-let lender. So, without blowing on a trumpet, we're quite well known in the market within people that look at mortgages. They know about us. We've hired people from a lot of the top buy-to-let lenders, quite high-profile people in the mortgage industry. So our brand in that world sort of bats above our size, if that makes sense.
Yeah.
And actually, we were not aware that this particular institution was actually looking to invest in mortgages. And someone introduced us and said, "Oh, you should go and speak to them. I think they're interested in funding mortgages." And I think they hadn't contacted us directly because I think they thought we were fully tied up already with other institutional funders. And so we met mid-February, and we were at term sheets, within a matter of weeks. And then having done DD, and then obviously the legal process took a little bit longer. So it was actually a pretty quick deal for something of that size. We've been through due diligence before a number of times by institutional investors. So and they had it on the other side. So we both knew what we were doing, and we got through it pretty quickly. And then, obviously went to legals, and then that naturally takes a little bit longer and starts to become a bit more expensive.
Right, I'm sure. Yeah. So I presume it's they've decided they don't want their name released. Are we going to find out about it eventually, or is this going to be something that'll always be hush-hush?
Well, yeah. I mean, I think obviously, as you can imagine, we would have loved to have named them.
Right. I'm sure.
They're a very blue chip financial institution. It's certainly someone we're quite proud to be working with, but unfortunately we can't name. At some point, the expectation is that those loans will be securitized. That's the likely outcome. And so at that point, obviously, then it does become in the public domain. And so, but that's their call. Obviously, when they securitize loans, and then by definition, it does come out. So.
Right. Right. Okay. So then what? So that was a £1 billion commitment. What can you tell us the scale that you're at today?
Yeah, so now, I think to date now we've lent 350 million, and we're our sort of, this month we're sitting in obviously middle of 2019. We'll lend about 30 million a month. I think by year end that will hit closer to 40 or so. So we're running at sort of decent scale, but that will take us a few years to get through. And bear in mind, not all of our origination is going to this institution. We have other institutions, so it's not we haven't removed any institutions from the platform at all. So the expectation is that that billion will be fully deployed in about 3 years. And again, in very simple terms, we would expect, broadly speaking, for them to do a pool of around about 300 a year, and then to securitize every year. So the way we think about it, it probably is 3 securitizations, broadly speaking, every year, if that makes sense.
Right, okay.
It may not work out exactly like that, but that's kind of back of envelope, kind of how it should work.
Right, got it. Okay, so I do want to ask you about the state of the market and the dreaded B word, which I'm sure you're totally sick of talking about, but I think...
A B for Boris?
Boris and Brexit might be very, very well intertwined here pretty soon. But yeah, so I mean, obviously the Brexit is still looming, and with the current state of affairs looking like it's possible that a hard Brexit might actually be on the horizon. I wanted to get your sense about how are you thinking about that. Obviously the impact is unknown, but the impact is going to be negative. That much I think is everyone would agree on, and particularly on the property market, which had some challenges in the financial crisis. You said that your part of the market did well, but how are you thinking about Brexit and the possibility of a hard Brexit that is going to cause an economic shock to the UK?
Yeah, I mean, it's, as you know, P, you're a regular visitor to the UK, and obviously this is now 3 years since the referendum, and a hard Brexit has loomed as a possibility a number of times, and certainly this year, and it's made zero impact in terms of unemployment to date. Quite the opposite. The employment and wages have been pretty resilient, actually. But quite the opposite, more than resilient. I mean, they've been phenomenally strong figures throughout. So the broader economy, has still continued to perform pretty well. And again, as you can imagine, certainly around the turn of the year, when obviously at that point, March the 31st was kind of the deadline, or sorry, late March, I can't remember if it was 31st or not. And so we're sort of back there, I suppose, in terms of the amount of time till we potentially leave the EU. And, we went to speak to institutions that fund ours and say, look, what's your take? What's your view on the mortgage market? What happens if we do? Are you still committed? And we've certainly seen this over the course of this year. It's not just obviously the deal we've announced. The appetite to invest in the UK mortgage market for different types of funders, whether it be banks or non-banks, is still there heavily. I mean, and obviously we're now quite an established platform. There's less execution risk, but there doesn't seem to be any funding risk as far as I can see, despite being Brexit on the rise. And there still is an appetite for various types of institutions to deploy into the mortgage market, which, considering what you've said, like you say, it's quite surprising. You think a lot of people would think, well, let's just sit this out, but that does not seem to be happening in our market, and maybe it is because what we do is relatively defensive. You're right in terms of the broader property market. In London, we've definitely seen over the last 2 years a sort of softening of the London market, not by a huge amount. I mean, it's fallen by a few percent here or there, where actually the higher value properties have fallen more. But it's worth pointing out there's been some changes to stamp duty about 3 years, around about the same time as the Brexit referendum. And so more expensive properties got quite a significant hike in stamp duty just before the Brexit referendum. So that hit the London market quite seriously anyway at that point. Obviously, there is then this concern in terms of how it affects bankers, and obviously in terms of people on high income, bankers is a significant part of it in terms of the banking sector. And also, it's worth saying, the threat at the same time, which is maybe linked to Brexit. There's obviously a potential threat of a Jeremy Corbyn government who have been quite vocal about property taxes and bankers' taxes as well. So you've got this sort of perfect storm in some ways for high-value London properties where potentially they're going to get taxed more by Jeremy Corbyn. There's going to be a Brexit, there might be some Brexit impact directly in the property market, but also in terms of bankers' pay and jobs market, et cetera, et cetera. So London has definitely been affected, and part of that is Brexit. I think some of it is stamp duty, some of it is probably a potential risk of further property taxes by a changing government. So you've definitely seen that in London. Actually, in the rest of the UK market, we haven't seen that. We've seen actually property prices continuing to tick up slowly, not at fast levels, at maybe 4 or 5% a year growth. Inflation in the UK is 2 to 3%. So there's been a bit of a catching up in the rest of the UK, whereas obviously the London property market was, running at sort of double-digit price growth up until around about 3 years ago. And it's, in some ways, I think actually it's probably a good thing that the sort of the London market, the steam of it has been taken out a little bit.
Right.
Obviously, in terms of Brexit and what happens and whether it's hard, whether it's soft, whether there's a deal, if there is a hard Brexit, how quickly we adjust to it, what the Bank of England might do in terms of things like term funding scheme, which is they did after the referendum in terms of injecting money in the system, we don't know. But, while I think people are talking about it a lot, that there doesn't seem to be people seem to be getting on with stuff, if that makes sense. They don't seem to be delaying decisions based on, we might have Brexit in 3 months and we don't quite know what it looks like. So for most businesses we know, it's business as usual, which like you say, when something that could be very hard and could be quite a shock to the system, it's covered more in the sort of political pages of newspapers compared to actually what people talk about on the ground. If that makes sense.
Right. Yep. Understood. Okay, so we're almost out of time. A couple more questions here. I know you've been to the US many times. You've come to lend it several times, and I'm curious about any plans for international expansion, not just the US, but maybe into mainland Europe as well.
Yeah, so it's something we kind of always look at. It's not on the immediate horizon. We still think, I was saying that the UK market in the buy-to-let is, just under 40 billion a year, 240 billion outstanding. We want to become a leading player here, not just a leading fintech in the space. We want to be, the leading buy-to-let lender. So we've got a long way to go. This year will be about 1% of gross lending in the UK buy-to-let mortgage market. We want that to get to at least 5%, maybe as much as 10% over the next 3-4 years. So we've got quite serious growth plans in the UK. And that we're pretty focused on that. We do keep an eye on other markets. The US market, because of Fannie and Freddie, is quite complicated, particularly the buy-to-let market. Obviously, there's some element of regulation in it. So we've looked at it before, and it's very different to the UK market. And so our instinct is, what markets are similar to the UK? And there's the Irish market, but that's pretty small. There's the Dutch market, which is quite interesting, but still very small, but it seems to be growing. And there's the Australian market, which is interesting, but a long way away.
Right.
So they've all got issues, and we do keep an eye on all of them, and we sort of look at them, but there's nothing on the horizon the next 2-3 years, because whenever we've looked at it in detail, you sort of think, well, where is the best place for us to grow today, next year, and even the year after? And the answer to that question is always the UK. Okay,
yeah, that makes sense. Okay.
And at some point, when it ceases to be the UK, then the question is, do we move naturally into other parts of the mortgage market, or do we do something just, exactly what we do in the UK, but then transport that into another geography?
Right. Okay, then. So, looking out over the next 12 months, what are you working on? What's next for Landbay?
Well, a large part of it is to do more of the same. To continue to diversify funding. Obviously, we've got this billion we want to sort of get through as quickly, but obviously safely as possible. We're about 80 people now, and that's up from about 55, 60 at the beginning of the year. As I was saying to you earlier, before we started recording this, we've just taken on additional office space. So we're making a massive investment in technology, and the focus over the next year is to grow brand and our business in the buy-to-let market on one side with our sales team, and we've already made a lot of progress there. But the next thing is actually we think we can use technology a lot clever, not just on the origination side, but how we allocate loans, how we process loans, how we automate bits of the process, how we report to our institutions, how we allocate loans cleverly, et cetera, et cetera. So there's a big investment that we're doing there and growing the team. So we're quite, over the next year, I think a lot of what we do is going to be quite internally focused on that side to sort of really build what we've got. And I say it's not just on the front end origination side.
Right.
I think longer term, I think I've said this before, so I'm not giving away secrets. Our plan for the business is to IPO it. That's still quite a number of years off. But we've always thinking, okay, well, actually, we've got to get the structure, the governance, the reporting in line so that we can operate in a few years from now as a publicly listed company. So that's always in the back of my mind. But that's a longer term than that's not 2020. That's probably 2022, if that makes sense.
Okay, great. Well, we'll have to leave it there, John. I really appreciate you coming on the show today.
Thanks a lot, Peter.
Okay, see ya. It's interesting to me that when I talk with people in the UK, even, particularly the CEOs of these fintech companies, and it's amazing to me how many of them just, one, they're sick of talking about Brexit, but two, they just want to get on with it. And, Brexit is still looming large certainly as I said, in the political pages, and most people are just getting on with it and, will deal with whatever ramifications it creates. And, obviously a hard Brexit is going to be terrible, I think, for the UK economy. But as I said, investment is still flowing. You saw John talked about the £1 billion commitment he's done. That was in the light of obviously knowing a hard Brexit is a distinct possibility. It's going to be, we'll know completely in a few months' time. But right now, the UK is just getting on with it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's show was sponsored by Lend Fintech Europe 2019, Europe's largest fintech event for lending and digital banking. It's taking place on the 26th and 27th of September in London at the Business Design Centre. Lending and banking are converging. Lend Fintech Europe delves deeply into this new world, bringing you the latest developments in the most important areas of fintech. Lend Fintech, lending and banking connected. You can find out more and register at lendit.com/Europe.